Earlier this week, I made a big change in my portfolio, and I think some people might not be happy with it once they hear what it is. If you've been following the channel for a while, then you know that I regularly dollar cost average into positions. Every 2 to 3 weeks, I'm buying more and more stock. Been doing that consistently for the past 5 years. And you'll also know that my time horizon is fairly long, and as a result of that, I don't sell stock very often. The last time I had any sells at all in my portfolio was almost a year ago. So these videos are fairly rare for me to make, but I want to make them regardless so that I can explain my thought process, how and where I reallocated that capital, and how I'm thinking about things moving from here. So I've been thinking about this trade for about a month now. I actually posted my idea on Discord around the thought process of why I want to do this. I dove into this company's financial statements and spent a few weeks actually monitoring the trade to not be impulsive, essentially. And I wanted to make this video for a couple of reasons. Number one being transparency, but also to share my thought process and look back on it maybe 12 to 24 months to see if it was the right decision or absolutely a bad decision for me to make. Now, many of my positions going into 2022 were growth-oriented companies, and they got hit that year disproportionately to the rest of the market. I mean, the Nasdaq was down 30-something%, the S&P was down 12%, and so as a result of all this, in general, 2022 was a pretty rough year for the portfolio, but I wasn't too concerned for a couple of reasons. Number one, I was still actively buying into these positions and building them out, and number two, my time horizon is decades long, so in the grand scheme of things, this was a buying opportunity more so than anything, especially because, relatively speaking, I'm still early on in my investing career. However, one thing I did do in 2022 was concentrated into my highest conviction picks, into the picks essentially that I think are the safest moving forward. And as a result of this, my top two positions, number one, Tesla, and number two, SOFI, made up over 50% of my portfolio. And my top five positions made up over 75% of my portfolio. So a lot of concentration into my top names, especially as everything else fell. So concentration was one aspect of this trade. The other aspect is I wanted to take advantage coming out of 2022 of the disproportionate drops as a result of that year. And overarchingly, I wanted to add to companies that had, number one, retained their growth rate, that were still growing despite the market macro conditions tightening. And number two, they had some sort of financial security, or in other words, padding to cushion the drop. So cash on hand is a great one. No debt is fantastic for me to see in general. So these were the sorts of things that I was thinking about, being a little bit more conservative in my mindset, a little bit more towards valuation than pure growth, as we entered some tough economic times. Now, why did I sell this company versus just wait to add new funds? Well, my DCA strategy as a whole is something that I continue to do, but that takes a long period of time for me to eventually build a large position. Number one. More importantly, number two, this was in a tax haven account. The total allotment of how much new capital I can add to that account is very, very restricted. I think overall in 2023, I could only add like $7,000 in net new money into this account particularly, which when everything else has fallen like 50%, it doesn't allow me a lot of wiggle room to balance out some of my positions. And what that did was it forced me to take a look at all of the companies that I had that were still in the green. And despite everything that happened in 2022, I've been investing since 2017 regularly, like I mentioned. And so a lot of my names were still relatively in the green, despite that huge drop, because the cost bases were so low on some of these names. And so one of these companies that I inevitably took a look at was Etsy. I first bought Etsy in 2018 or 2019, I think. I bought it around $40 per share, and I kept adding to it regularly, as high as $200 per share, I think, in 2021. My cost basis was still fairly low on the company, just above $100 per share. Now, back in 2021, Etsy peaked at $295, so that was about a triple from where we stand today. However, a lot of things in my portfolio were doubles and triples and 5Xs back then, and it all has fallen down in 2022. As of this week, I've sold a huge chunk of my Etsy position, and I locked in something like a 15 to 20% gain, which if you take the opportunity cost of how long I've been holding that stock, it's negligible and even undermines the index itself in terms of the actual gains. But like I mentioned, this is a long game, and I'm just always trying to optimize that position for myself, looking out in decades. So why did I sell Etsy specifically? Well, for starters, Etsy, the company, relative to where I reallocated that capital, is not growing as fast from a revenue perspective. Their growth has massively dwindled. They're still growing, don't get me wrong, but they're growing at a much slower clip. Number two, I was still positive in terms of my Etsy positions. I'm still getting some returns. I'm not like 90% in the red on that position, and it doesn't even make sense to sell anymore. Number three, Etsy has not been disproportionately sold off to the same degree as some of the other names in my portfolio. On a 1 year basis, Etsy is only down 17%, which is better than even the NASDAQ for that same time period. So if you think of SOFI, for example, which is down 70%, if you think of Tesla, which is down 70%, and you think of Etsy, which is down 17%, that allows me to really scrutinize the internal workings and the actual valuations of a lot of these companies relative to how much they're growing and relative to their financial security as a whole. And finally, number four, if we take a snapshot 12 months from now, 24 months from now, I believe that these companies where I reallocated the money are going to be outperforming Etsy from a returns adjusted perspective. If nothing else, just because they were disproportionately sold off. So for example, let's say SoFi, which is one of the companies where I put that money, has fallen from $25, which is where it peaked in 2021, down to $4. Well, that's like a 5x in terms of that return just for them to reach that level again. Whereas with Etsy, the max it ever got was over a 2x from where we are today. And so I think that overarchingly, this disproportionate falling made me really scrutinous to reanalyze all the companies in my portfolio from this day onward. Do they still make sense relative to each other as the best place for me to allocate my money? Without further ado, the companies that I reallocated these funds into were Tesla and SoFi. The funds from Etsy were split 50-50 into those two positions, which means even more concentration for myself. Now, very quickly, let's just jump into why these two stocks specifically. Starting with SoFi. I think 2023 is going to be a breakout year for the company. I think that they're going to be profitable towards the end of 2023, as opposed to many analysts who think that it's going to come in 2024. I think there's going to be big partnerships with legacy institutions on the Galileo side of things. I think that we're now seeing the cross-selling flywheel really ramp up on the consumer side, so their B2C business. There's absolutely a whole ton of things to love about SoFi. My channel is basically dedicated to SoFi, but at the heart of it is the diversification in product offerings and how that links to them being a one-stop shop. SoFi is my second largest position. It's around 15% of my total portfolio. I've been investing in SoFi since IPOE, dollar cost averaging all the way down. With this latest purchase, my cost basis is around $8.50 on SoFi, roughly speaking. And safe to say I'm very, very bullish on them going forward. Okay, so now let's move on to Tesla. I think Tesla has been massively disproportionately sold off. A lot of it is short-term noise with Elon being distracted by the Twitter acquisition, which will fade over time. The other reason for the sell-off is macro. I think Tesla will have a rough 2023, don't get me wrong. I think from a margin and from a demand perspective, the company is going to be hit in 2023. However, despite that, I think the company is absolutely solid from a growth perspective, from a production perspective, from a financial point of view. Their cash on hand, their debt position, everything is pretty healthy from that perspective. So I think that they're going to coast through 2023 no problem, despite being hit. And as of this recording, demand seems to be the main question right now when we enter a time where people don't want to be spending as much on these large ticket items. I think relative to all their competitors, Tesla is going to be much less hit because of their healthy margins. They can go ahead and cut prices, which will hurt their profitability, don't get me wrong, but a legacy automaker can't do that because they have much fewer margins to play with without starting to lose money. And just case in point to this video, earlier this week, Tesla went ahead and cut their prices as high as 20% in some models, and we're immediately seeing search volume skyrocket from a Google Trends perspective. Inventory is down over 50% in a matter of days. Used car reselling websites like CarMax have quickly being sold out of their inventory in a matter of days as well. So I think that that demand is artificial, that if they lowered the prices just a little bit, they can become cheaper than any other car in the market in their category. Number one, they're already one of the highest quality cars in terms of satisfaction ratings from multiple surveys. And yes, they're going to make less money from a profitability perspective, but they can boost that demand up higher as they see fit. And I won't go in too much into depth in terms of their long-term bull case from all of their other product lines. I think I've talked about that at length. Their investor day on March 1st, where I think that they're going to be revealing a new product. They talked about their next-gen capabilities. I made a full video about it. Definitely check that out. So by no means do I think that 2023 is going to be a great year for Tesla. However, I think that that this is a great price to enter Tesla at. It's the cheapest it's been in a long time. And I think the company has straight up executed in terms of delivery and production numbers for a long time, especially when you compare them with legacy car makers. To grow 40% in a year is definitely nothing to wink at. So I really love Tesla. I really love SoFi. Obviously, they're my two biggest positions. I think the flip side of this trade, just to wrap up this video, is I was thinking a lot around Etsy specifically. The massive layoffs that we're seeing today is going to lead to many more people entering the gig economy. So Etsy's seller numbers, their seller marketplace, is going to be higher and higher. However, I don't think that this also accounts for the demand, because there's going to be, again, less discretionary spending. So I don't think Etsy is nearly going to suffer as much as Tesla will in 2023. But at the same time, I think Tesla has a much bigger runway for growth than Etsy does over that same period, or even 2 to 3 years from now. And again, one of the disclaimers is I still own Etsy stock. I sold out completely in my tax haven account, but I still have Etsy in another account. I did sell out around 60 to 70% of that stock completely, though, to reallocate into Tesla and SoFi. Time will tell if this was a good move or a horrible move, but I wanted to share my thought process with you regardless. Just as a reminder, I am still DCAing in every 2 to 3 weeks, mostly into a small handful of my core stocks. Periodically, I'll post updates around my portfolio and how that's looking. However, similar to 2022, I think 2023 is going to be a heads down year where we're just building on that portfolio regardless. It's definitely not going to be anything pretty in the short term, but I think these are golden opportunities for the long term, especially someone like myself with decades long time horizon. I'm very excited for that, and I want to be taking advantage of these dips as I see fit. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.